Welcome back, you legends. I'm Dr. Kyle and I have a great one for you today, guys. Grab your snacks and stick around. This is going to be a really good one. So let's get right into it. S&P up 1.85%, NASDAQ 2%, Dow Jones 1.65%. Green everywhere on Friday, as we expected, a rally on Apple earnings. Let's take a look at the weekly stock market map, and it shows something completely different, right? We're seeing tech leading Apple, Microsoft, Nvidia, as well as Tesla. And we're seeing energy and financials lagging. Let's take a look at the different sectors on the weekly time frame here, guys. Tech leading, healthcare and utilities. So we're seeing somewhat of a strange shift here where money is going into tech as a safety trade, right? Because tech is leading alongside these safety risk-off assets like healthcare and utilities. And we have the risk on inflationary sectors, GDP expansion sectors like energy, financials lagging. So we're seeing this dynamic where the stock market consensus now appears to be shifting into, yes, the economy is going to slow down, but we think that big cap tech is going to be safe, which is kind of bizarre. This is honestly the first time where we're seeing actually tech, which is the risky risk-on sector, leading in a defensive move. This is the first time ever that we've seen anything like this, and it started when the smaller regional banks began failing. I want to get right into the meat and potatoes of this video, and I want to pull out the thumbnail for the last video. Warning, smart money just sold ahead of Fed meeting. The smart money was up top, dumb money down below. And I put out these projections, and these weren't just, guys, some random projections. These were actually measured. And here's the funny part. We actually bottomed exactly at the bottom of the measurement. So we had this negative divergence where smart money was making a lower high as the dumb money, the S&P 500, was making a higher high. An identical sort of divergence actually happened in the prior top. As the S&P 500 was making a higher high, the smart money was actually selling. So this established a very clear negative bearish divergence, and it was the smart money hinting that yes, weakness is coming into the market. And that's when I put out my last update video just before this sell-off, and I showed this in the actual thumbnail, the exact measurement, and we actually bottomed pretty much at the bottom of the measurement here. So we had that sell-off and a rally on Apple earnings. Now, admittedly, guys, I was actually expecting the market to sell off all the way to the bottom on the Fed day and then recover and rally at the same day. But we ended up actually making one more negative day, one more red day following the Fed meeting, and then we had the recovery. So we had one extra day of selling to get us to the bottom of this range before we had that rally on Friday, thanks to Apple beating. And this is a bit of a predictable pattern, guys. We saw this pretty much every single time Apple reported earnings. We had a rally post earnings on Apple, where Apple pretty much pushed the entire stock market up, specifically led by the tech sectors, as we saw in the stock market map, with tech, big cap tech, leading the week. Now, I want to start the video with this chart. This is the NASDAQ 100 daily chart. And I want to point out a few very key but subtle changes that I'm noticing on the chart that really nobody's talking about. So let's get right into it. So we had that bottom back in October. We had a rally, another low, and we formed sort of an head and shoulders, inverse head and shoulders formation. Then we rallied, we established this neckline, right? We stopped at the resistance, rejected once, twice, 3 times, 4 times. Then we had the sell-off. Now I measured the slope, or I should say the angle of the sell-off, and it was 75 degrees, a negative 75 degree angle. Then we had this impulsive rally from the December lows. We had a lot of clues that the market was actually going to rally back in December, a lot of bullish divergences that I talked about back then. Then we had this rally, and it topped right here at the extension of this resistance line. Then we pulled back at a shallower angle of negative 46. We rallied again, and we're now pulling back at an even shallower 21-degree angle. Now, it's not just that I'm noticing, guys. I'm also noticing another pattern, and it's this. This was a 20% rally from the bottom to the top, 20.7%. Then we had this rally from the bottom to the top here, 12%. And if this continues, if this fractal pattern continues, and it is likely to continue, we will see the market top, let's see, at a 7% rally right here. Why is that? Well, if you divide 12% by 20, we then realize that this triple 1, 2, 3 wave pattern has been contracting at a rate of 40%. So this wave is 40% smaller than this wave, and this wave is expected to be 40% smaller than this wave. And so we went from 20% up to 12% up to 7% up. And here's the kicker. Now, if we rally by 7%, and if we assume that the market will continue in this contractionary fractal pattern, putting up this bearish ascending wedge pattern, we will top, let's see, at $332. And what do you know? This is the exact full measured move of this double bottom, right? This double bottom right here, if we measure the distance from the bottom all the way to the neckline, we double that, we get the full measured move. And lo and behold, it's the exact same spot. I mean, you can't make this up, guys. You cannot make this stuff up. It's the exact same target. So 20%, 12%. Now I'm expecting a 7% rally bottom to the top, and a high that closes right at the full measured move to fill this unfilled gap right here at $330. There's another small gap up above at $332. Both of these are expected to be filled next. Now, this type of analysis, guys, is called fractal analysis, and we look at the fractals of the market. So this is a fractal structure. This is another fractal structure, and here's another one. Usually, guys, we actually need supercomputers, AI, stuff like that to really find these structures. But if you pay very close attention, you do these measurements manually, you also can get the same sort of target. So this is the NASDAQ. And so again, from the bottom to the top, we're expecting a 7% rally. Now, this goes hand in hand with my last projection that I talked about, which was a pullback back down to the range, then a rally on Apple earnings. Now, admittedly, I expected the market to rally on the Fed and rally on Apple, right? Complete the pullback, then rally 2 days in a row. We ended up with a pullback that lasted one additional day. Then we had a rally on Apple. Now, this rally is likely not done quite yet, guys. And again, I'm expecting a rally to 422 on the SPY, and that would put the NASDAQ at that exact same $332 on the triple Qs to fill the gap right here, this gap at the prior high from August. Now, I have to make this absolutely crystal clear, guys. This does not necessarily mean that we rally straight up. We could get a lot of choppy trading, especially because May tends to be one of the worst months seasonally in the entire year, and especially the second and third weeks of May. That includes the next week and the week after that. And on top of that, we have the debt ceiling crisis. So a lot of really mixed bag. So this fractal structure could prove to be a lot more complex than this, but the full measured move, the objective target is $332 for this third wave up. So what are we expecting in the short term? Is the pullback done? Is this it? Now, this is an incredibly important and very hard question to answer. And honestly, the answer is yes, I do think the market will fill this gap. The more complete answer is I don't know exactly when. So do we get a rally, a continuation up, get that move to 422 on the S&P, get that rally to 330 on the triple Qs, and do we then get that pullback to fill the gap here finally and then move back up? I think that's possible. Do we get more sideways action, then we fill the gap, then we rally? I'm in favor of the former, a continuation first, and then a pullback, than a rally. So how do we actually trade this? In a period of extreme uncertainty like this, where we don't exactly know which wave is going to come first, are we going to fill the gap first, then rally, or are we going to rally first? In this example, I would lean away from the S&P 500 and into picking specific stocks that have advantages, relative performance that is superior to the S&P 500, and I would lean into that because this is a period of extreme uncertainty, right? We have, again, the debt ceiling crisis. We have May being a very seasonally weak month in the year, and we have this unfinished business down below. My personal opinion, my personal take is that we are likely to see a rally, a continuation of the rally first, and then we move back down on the debt ceiling crisis as we get closer and closer to the debt ceiling limit date, which is June 1st. That's when Janet Yellen has warned that the US will run out of cash. The Treasury is expected to go bankrupt by June 1st if the debt limit does not get raised before that date. So in the short term, guys, this is a major risk to the market. Long term, they always reach some sort of settlement. They always reach an agreement and they end up raising the debt limit. Now, the question is, do they stall? Do we actually get a couple of weeks of government shutdown before we get a resolution to this issue? Or do we get an agreement before the June 1st deadline? That's impossible to answer. And that's why this entire period between now and June 1st is an exceptionally risky period. Now, if we get a headline that we got some sort of resolution and they agree to raise the debt limit, you will see the market rip up before it pulls back. And if we get the opposite, if we get some sort of deadlock issue, the market is more likely to fill the gaps first before moving back up. In either case, I think that the debt limit crisis is going to be a necessity to push the market back down to fill the gaps below, because the VIX has been very calm for quite a long time now, and we need a risk event, a major risk event, to push the VIX high enough to get the market low enough back to 395. I hope that makes sense. Guys. Now I'm going to jump into critical charts. Please, guys, please, if you're the kind of viewer that skips through the video, now please, it's time to pay very close attention again. And I want to talk about this chart. Up top is the S&P 500. Down below is the Dow Jones Transports. And what do we have here? Boom. This is a bullish divergence. Marked the October bottom. The market rallied. Boom, another bullish divergence here, marked the December bottom, the market rallied. Boom, a negative divergence, marked the November high, the market crashed. And what do we have here? A bullish divergence so far. We could get a pullback here, but I think that this bullish divergence is likely to hold. And it indicates, it leans more towards the idea of a rally first to 422 on the SPY, 4200 on the SPX, a little bit more than that, probably 4250, and again 332 on the NASDAQ 100. Before we get a pullback, that's what the bullish divergence is telling us, that in the short term, the market is now leaning bullish. And so what makes sense to me is that we could see a rally again, fill all of those gaps, form that high for May, and then get that violent sell-off all the way back down to 400, fill this gap at 401, move even lower, fill the gap at 395, establish the low probably closer to the beginning of June, and then we get another move back up in the market. If you've enjoyed the video so far, slap that like button while you're watching. And legends, if you do enjoy and you want to see more of this complex fractal analysis and you find it helpful, do let me know in the comments or by liking the video, because I'll take that feedback from you guys and I'll apply it in future videos. This is the daily chart for the S&P 500. The projection for the next high is again still at 422. On the SPY. The PPO is slightly improving here, guys. The smart money time machine, smart money flow indicator hasn't yet put in a buy signal here, because very likely now we are in a period of choppy trading to put in that high, very similar to the choppy period back in late November before we put in that final high. If we take a look at the S&P 500 1-hour chart, we had these lower highs, consecutive lower highs. Then we broke actually above this resistance line that held twice before the Fed meeting and the day of the Fed meeting. It has now been broken through. The full measured move on this kind of structure, let's take a look, is about 416. So again, we could, guys, push higher to 416. Then we could get a decision, either fill the gaps below first at 395 or continue higher to 422 on the SPY, 332 on the triple Qs, put in that high first and then pull back. So the question now is, do we get a continuation up first before we pull back? So 422 first, then we pull back, or do we get a rally to 416, stall again, perhaps the debt ceiling crisis kicks in again, and we get a pullback before we put in that high? So that's the key question now, and really the only way to trade this is to watch the reaction at 416. Again, short-term bullish divergences tend to tell me that we will move past this level of resistance and take out this high. That includes the bullish divergence between the S&P 500 and the Dow Transports. Again, this is the NASDAQ 100. We're getting a bullish divergence here on the PPO histogram, but we haven't yet gotten a bullish crossover. We could be very close to that bullish crossover, and I think if we get that, and if we clear these highs, if we put in a new closing high, I think that immediately tells us that we move higher first to this level of resistance at 332 first before we pull back down. This is the NASDAQ relative to the S&P 500. Again, every single time we had a bullish crossover, we had a rally in the S&P, the overall market. And I'm going to add the S&P on here so you guys can see what I'm talking about. Notice bullish divergence and the S&P rallied, another bullish divergence, the S&P rallied, another bullish divergence, bullish crossover, mark the low, and we're likely going to see a rally here. So again, we have the transports telling us that yes, there's a bullish divergence, and we have the ratio chart between the NASDAQ and the SPY telling us that short term we are likely to see a continuation of the rally before we go back to fill the gaps below. Now, if we take a look at the bond market, the S&P 500 is in blue and black, and up top is the bond market risk appetite indicator. We have a significant bearish divergence here, and we have a bearish cross down on the PPO. Usually, guys, when we get a bearish cross, we get a continuation of the selling. So again, we have conflicting data here. We have the bond market going absolutely nuts because of debt ceiling. We have short-term yields going absolutely bananas, but we have the stock market rallying. It's as if money's actually flowing out of bonds and into big cap tech companies as a safety trade, which is absolutely nuts. This is the opposite of what usually happens. Usually money flows out of big cap tech and into bonds in a risk-off move. We're now seeing the opposite. We're seeing money flow out of bonds and into big cap tech for safety to address the debt ceiling crisis, which is absolutely nuts. We haven't seen this ever. And again, that tells us no matter what happens next, we are likely going to see a top very soon, whether that's 416 or 422 on the SPY. A top is very likely coming, and a significant correction down to 395 is inevitable this summer, very likely again early June. Now, if we take a look at the VIX had an initial breakout above 20 for one single day, right? We had a wick above, then we closed at 20, this significant level of resistance. It acted as resistance throughout the March period, and again here, and again here, and then it held. Even though we had a spike through it, it held, formed this low on the S&P 500, and we had a massive decline in the VIX. Usually when the VIX is down more than 10%, and on Friday it was 14.4%, usually we get a spike back in the VIX in the next two trading sessions. So we either get a rally Monday, then a pullback on Tuesday, or we immediately get a pullback Monday. But a pullback is imminent because the VIX got crushed, and that's usually what happens when the VIX moves down by 10% or more in one day. It is possible that we may get another backtest of this support line that held throughout this year. We might get a backtest of the support line before we get the final high, that 422 high on the SPY, before we get that massive correction down to 395 on the S&P 500. Another possibility here, guys, is that the VIX could form an inverse head and shoulders bottom here, pull back all the way back down to 16.3, form a right shoulder here as the market makes a slightly higher high, moves up back here, makes a slightly higher high, and that would establish a massive negative divergence between the VIX and the S&P 500, and that will once again help us pinpoint the exact top in the market. If we take a look at the put to call ratio, the Money Time Machine PC buy and sell signal, we had a sell signal on April the 26th. Finally, we got a bullish cross on the PPO. Then we had a bit of a bounce back up and we moved lower, but notice the PPO has established a higher low as the S&P made an equal low here. That again tends to tell us that a topping process is taking place, whether the top has been made here, whether that's going to be at 416 on the SPY, or whether we're going to see a slightly higher high at 422. That's really the question now. Do we get a slightly higher high from that final high as the NASDAQ pushes slightly up, or do we get a continuation back down? So in periods like this, guys, again, extremely uncertain times, I tend to lean into individual stocks and try and avoid over trading the market and the indices. If we take a look at the New York Stock Exchange, McClellan's volume summation index, still negative, still pointing down, oscillator still red. But if we take a look at the summation index for the NASDAQ, it is actually curling back over, and it's probably a day away from completing a bullish cross. So again, there's a bifurcation in the market. We're seeing continuation of the move up in a big cap tech, while the rest of the market remains negative. This is the 50-day S&P 500 breadth up top. This is the S&P 500 down below. Again, continues to put in lower highs as the S&P 500 is trying to make higher highs. Breadth is a negative. It has produced a sell signal back in late April. And again, the picture still looks very murky. And in my opinion, a cash position is a very wise position in periods like this. This is XLK divided by the SPY, so TAC divided by the S&P 500. And we had a bit of a bullish crossover at the zero line. And we are likely now pushing back up, maybe to make an equal high, maybe a slightly higher high, again, as the NASDAQ tries to push to that 332 level on the triple Qs. Another possible indicator that we're going to see another leg higher in tech is the SMH, the semiconductors index. And what I'm favoring at this point, at this juncture, guys, is this: a left shoulder, a top, a head, and a right shoulder that is now probably forming before we get a break below the support line. So again, potentially a rally to 422 on the SPY, a rally to 332 on the NASDAQ, and again, a pushback higher by the SMH, the semis, before we get that larger correction to fill the gaps below on the S&P 500. Other notable changes is retail favorite stocks, meme stocks are now rallying again. We had a bullish crossover on Tesla. We did not yet fill the gap at 145. We hit the top of the gap. Then we bounced back up. We could potentially see a gap fill at 184 on Tesla. Again, connect back with the 50-day moving average, then continue lower to fill the gaps below. And this push higher could be what takes the NASDAQ to 332, the SPY to 422, put in that high, then go back to fill the gaps. So if we take a look at meme stocks like Corvana, we're seeing these really huge rallies, 24%, even higher at the open. And if I take a look at the meme stock index, the ME index, again, look at this double bottom, and we're getting a rally, a vicious rally that began after we put in this hammer candle at the bottom of the Bollinger Band on Thursday. Then we had that rally on Friday alongside Apple and the rest of the market. Usually, guys, meme stocks like to participate at the end of an uptrend. So again, this could be the final leg that pushes the market to those highs that I talked about earlier in the video. And again, Apple, this is the expected move post earnings, right? A low of 158 and a high of 172. We took out the upper expected move and we closed above it. Again, this melt up move has left this massive gap down here. So even if Apple pushes higher or consolidates in the short term, we need to see this gap back here filled sooner or later. Now, taking a look at the fear and greed index, guys, look at this. We actually made a higher low. We held and we're now trying to move back up. We haven't really seen that happen after the market has tipped over back in late February. We haven't seen that back in December. We haven't seen that really until we go back to September, when we had this period of slight bullishness in the market, when we had this vicious back test of the 20-day moving average. But this was a solid downtrend. This downtrend has been a meek downtrend, not really what the bears were hoping for. And again, usually guys, the market likes to top around the 75-degree reading. So again, we could see a push higher by the indices, especially tech and meme stocks, as we hit that 75 reading, then put in the high and move back to fill the gaps at 395. Market momentum still moving sideways. Stock price strength is weakening. Breadth is declining, as I pointed out. Again, we could see somewhat of a slight nudge up that puts the market at a slightly higher high as breadth makes a lower high, and that would establish a negative divergence. We could also continue to see the put to call ratio continue to rise as the market continues to rise, and that would again alert us to another bearish divergence. Market volatility consolidating here, a lot of choppy trading, very similar to the January period. It will likely need that debt ceiling crisis to hit crescendo for the VIX to push up high enough, again, to fill the gap at 395 on the SPY. Safe haven demand is improving, right? Stocks are beginning to underperform bonds. But again, this indicator could get a little murky here in the next little while as yields go crazy due to the debt ceiling crisis. Junk bond demand all over the place here. And what do we have next week? Inflation Wednesday, CPI. This is going to be the critical number that we're all watching, CPI Wednesday. This is going to be a major market moving event. We need to see core CPI come below forecast, below 5.6, because last month it was 5.6, so we really need to see core CPI move lower. Otherwise, the Fed would have to continue to raise rates, and that would be considerably negative for the stock market, because the stock market is honestly now pricing in a pause at the next meeting. So no more rate hikes, a pause by June, and lower rates towards the end of the year. And so if the Fed is forced to continue to raise rates at this juncture, this would be very negative for the stock market. Thursday, we also have PPI, and Friday we'll have the Michigan Consumer Sentiment Index. If you liked the video, slap that like button on your way out. If you watched till the end and you did not enjoy the video, I thank you for your time and attention, and I'll catch you in the next one. Bye-bye, guys.
Oh, wow.